Markets are moving fast. Tech just smashed to record highs. Central banks made shock moves, and tariffs? They're escalating again. If you're not tracking this, you're already behind. Apple's $100 billion power play, a surprise Bank of England rate cut, and China's trade pivot. These aren't just headlines. They're signals shaping your next move in the market. This is the Weekly Market Update, a cutting-edge podcast where two generative AIs, supervised by a former senior portfolio manager, deliver a sharp, timely synthesis of global market dynamics. We decode what matters so you stay ahead. The moves have already started. Don't let next week's market drivers catch you off guard. Listen now to the full episode.
What a week.
It really was dynamic.
Yeah, I mean, we saw tech stocks just absolutely soar to new peaks. We had central banks pulling off some genuinely surprising moves, didn't we?
We certainly did. And trade tensions.
Yeah.
They definitely dialed up.
Exactly. So our mission today, same as always, is simple. Cut through that noise, pull out the most crucial insights, and really arm you with the sharpest understanding of what truly matters, what happened, and what's coming.
Right. It's not just the what, it's the why, isn't it? We want to connect those dots, understand the patterns emerging from all this information.
Help you think critically about the implications.
Precisely. Especially looking ahead.
Okay, let's unpack this then, starting with the U.S. markets, because that rebound, wow, pretty remarkable.
It was strong. U.S. equities surged, and the Nasdaq led the way, didn't it? Up, what was it, 3.9%? Record close.
Yeah, impressive. Yeah. But what was really driving that beyond just, general market optimism, was it all tech?
Tech was definitely the engine.
Yeah.
I mean, doing some serious heavy lifting there. Apple, in particular, an incredible 13.3% jump.
13%.
Yeah. And what's really fascinating, and maybe a bit under the radar, is why. It wasn't just earnings. It came right after they committed an extra $100 billion to U.S. manufacturing over the next 4 years.
Oh, okay.
And that strategic move, crucially, secured them vital exemptions from those new semiconductor tariffs.
Right, the ones that just kicked in.
Exactly. It's a powerful example of how corporate strategy can actually navigate, maybe even mitigate, some of this geopolitical risk.
That is a powerful detail, a really interesting interplay between, corporate giants and national policy. And speaking of tariffs, the Trump administration certainly ramped things up. This new wave took effect Thursday, right? 100% on imported semiconductors.
Though U.S. production exempt, as you said.
Right. Plus doubled tariffs on Indian goods and 39% on Swiss imports after talks collapsed. It feels like a real escalation.
It does. And against that backdrop, you've got the Federal Reserve. Their stance is, well, it's noticeably shifted.
How so?
Officials have been hinting pretty strongly now at a September rate cut. That is, if we keep seeing softness in the labor market.
And the market's buying it.
Seems like it. Market pricing now implies something like a 90% probability of easing in September.
Wow.
And it's not just guesswork. It's driven by the recent data. The ISM Services PMI, for instance, a key indicator. It fell right down to 50.1, barely expansion territory.
Just hanging on.
Yeah. And then jobless claims. They've risen to their highest since November 2021. We're talking 1.97 million continuing claims.
So for you, the listener, that's a clear signal the labor market is softening, which hits confidence, spend.
Exactly. Critical engine for the economy.
It definitely paints a picture of some headwinds. But, markets have been so resilient. Do you think investors are really digesting these concerns? Or is it just like a buy the dip thing overriding fundamentals? What about the broader reaction?
That's a really good question. Because while the underlying data suggests caution that tech rally has been so strong, it's almost like it's pulling everything else along.
Right.
Maybe there's a belief the Fed will just step in if things get really bad.
What about bonds and commodities? Any signals there?
Well, bonds reflected some of that uncertainty. The 10-year Treasury yield, it was hovering around 4.28%. Commodities. Gold briefly touched that all-time high, $3,500 an ounce, before pulling back.
Yeah.
Shows some safe haven demand, right? Hints at anxiety.
Interesting.
But then oil fell quite a bit, more than 5%, down below $64 a barrel. So maybe that signals concerns about global demand, or perhaps ample supply despite the trade friction.
Boiling it down, what's the key takeaway here? Is tech enthusiasm blinding the market to tariff risks? Or is something else going on, like Apple showing strategy can mitigate geopolitics?
That really is the million-dollar question, isn't it? I think the crucial insight is, yes, tech is powering this rebound.
Yeah.
But those rising tariff pressures, the soft labor market, they're clearly keeping the Fed leaning towards easing. So it suggests a market that's kind of betting on the central bank, to keep things going, even as the global trade picture gets, well, messier. It's a fascinating mix, almost paradoxical.
Let's pivot over to Europe then. We saw gains there too. The STOXX Europe 600 climbed, what, 2.11%?
Yep, broader gains.
But here's where it gets really interesting on the central bank front. The Bank of England, a surprise 25 basis point rate cut, down to 4%. That feels like a truly bold move right now.
It was bold.
Yeah.
And not just any cut either. It was a rare 5-4 split decision. They actually needed a second-round vote.
Wow, really tight.
Yeah, highlights just how contentious that was internally. And they specifically cited labor market concerns for the easing.
Okay, but here's the kicker.
Exactly. What's really unique is this cut comes alongside a forecast that inflation is expected to rise to 4% in September.
Right. It's almost counterintuitive, like trying to win a race by running backwards, as you put it.
It does raise the question, doesn't it? Are they trying to get ahead of a slowdown they see coming? Or are they risking a policy mistake, easing right into potentially higher inflation? It tells you there's a serious debate about the UK economy's path.
A bold gamble indeed. What about the wider Eurozone? Similar pressures or more resilience?
We did see some signs of resilience. Retail sales, for example, they rose 3.1% year over year in June. That beat forecasts, which is positive for consumer activity.
Oh.
However, Germany, still the problem child of the region, you might say.
Uh-oh.
Their industrial output fell, and quite sharply. 1.9% in June. That's its lowest level since 2020.
Wow, why?
Primarily weak foreign demand. Orders were down for the second month straight. This persistent drag really makes you wonder what's happening there internally.
Lowest since 2020. That number really stands out. Why is Germany so vulnerable to weak foreign demand right now? What's the internal challenge? What's the bottom line for you, the listener?
Well, Germany's strength, its export-driven economy, is also its vulnerability in times like these. The global manufacturing slowdown, plus these trade tensions, it hits them hard.
Right.
Internally, you've got a mix of high energy costs, some structural issues in key industries, hindering their ability to adapt quickly.
So, the bottom line.
The Bank of England is signaling gradual easing on labor concerns, but Germany's industrial slump remains a significant weight on the whole European picture. Yeah. You've got this sort of push-pull, resilient consumers in some places, but a struggling industrial core.
Okay, let's shift focus again. Over to Asia, Japan's Nikkei 225 saw solid gains, up 2.50%, partly helped by some trade clarity from the U.S., right? A bit of relief there.
That's right. The U.S. confirmed those new 15% tariffs on Japanese exports won't stack on existing ones. That helps. Right. And crucially for Japan's big auto industry, those tariffs are actually dropping quite a bit, from 27.5% down to 15%.
That's significant.
It removes a layer of uncertainty, a big cost burden for Japanese exporters, especially in such a vital sector for them.
But despite that clarity, it sounds like there's some friction inside the Bank of Japan about what to do next, particularly on rate hikes.
Indeed. The minutes from their July meeting, they showed clear divisions.
Really?
Yeah. Some officials want to wait, see how these tariffs actually play out in the economy over the next few months. Others, though, think there might be scope to hike rates by year-end if things hold up.
So what's driving that split?
It reflects the mixed signals from their own economy. Corporate earnings have been strong, that's true. But real wages, people actually feel in their pockets, they fell 1.3% year over year in June.
Ouch.
And household spending slowed way down. It was plus 1.3% compared to plus 4.7% in May. So yeah, the domestic picture isn't all rosy. It's a very delicate balancing act for the BOJ.
Okay. And China. Markets gained there too, despite, some of that U.S. trade weakness we talked about. How do they manage that? Is there some hidden resilience?
China's July export data was really key. It showed a significant strategic pivot. Exports were actually up 7.2% year over year.
Despite the U.S. drop.
Exactly. What's fascinating is, yes, exports to the U.S. plunged 22%. But that was more than offset by strong performance elsewhere: Europe, Southeast Asia, Australia.
Diversification.
Precisely.
Yeah.
It highlights how they've successfully diversified their trade relationships, actively seeking new markets, reducing reliance on just one. Plus, a weaker yuan helped make their goods more competitive abroad.
Interesting. So, less reliance on the U.S. What about domestically? Any good news inside China? Consumer activity?
Definitely. The S&P China Services PMI rose to 52.6. That's its best reading in 14 months.
Okay.
It signals improving consumer sentiment, a domestic revival, especially in areas like tourism, travel. It shows the recovery is broadening beyond just exports, getting some internal strength, which is much more sustainable.
So the crucial insight here for you, the listener, Japan's strong earnings are kind of fighting against weaker household data. That keeps the Bojay's path uncertain, keeps that internal debate going.
Right.
For China, though, it looks like diversified trade plus that resilient services sector are really cushioning the tariff impacts. A clear strategic adaptation. Not just surviving, but shifting.
Well put.
All right, let's look ahead then. What's coming up that could really move the needle? Let's get you ready for the key data points next week. That's August 11th to the 15th, 2025. This is where the rubber meets the road, right?
Absolutely. In the U.S., brace yourself, it's a packed week. Tuesday, August 12th, the big one, CPI and core CPI.
The inflation numbers.
Exactly. And for you, this isn't just another report. It's the market's first real look at consumer prices since those latest tariffs hit. Absolutely critical.
Then Thursday.
Thursday brings PPI producer prices, weekly jobless claims, and the federal budget. Then Friday, August 15th. It's a data dump. Retail sales, business inventories, prelim consumer sentiment, industrial production, capacity utilization, and import-export prices.
Busy Friday.
Very.
Okay, across the pond. UK releases its unemployment rate on Tuesday the 12th. Then Thursday the 14th, we get preliminary Q2 GDP numbers quarter over quarter, year over year, plus the monthly GDP reading.
Yeah, the first big look at how the UK economy did right before that surprise Bowie rate cut.
Crucial context. Germany.
Germany, keep an eye on the ZEW economic sentiment on Tuesday, August 12th. That's a key forward-looking gauge of confidence there, especially watched after those weak industrial numbers.
Right. And Asia.
Japan releases its preliminary Q2 GDP on Friday the 15th. And China also wraps up the week on Friday the 15th with industrial production and retail sales for July.
Wow. That is a lot of data points. Each one could potentially shift market sentiment quite a bit.
For sure. So, given this data-heavy week, what are the potential pitfalls? What should you be watching out for? We've identified the top 5 risks.
Okay, let's hear them.
First, U.S. inflation surprise. This matters hugely because, like we said, first read since the latest tariffs, the risk. A harder-than-expected CPI could really push bond yields up.
Dampening those rate cut hopes.
Exactly. Dampen hopes for a September cut. Conversely, a softer print probably cements that easing, boosts risk appetite. So Tuesday's CPI is pivotal.
Okay, risk number 1, what's next?
Second, U.S. consumer resilience. Why it matters. Upcoming retail sales and sentiment data will show if tariffs are starting to bite consumer spending, or maybe the market rally has made people feel wealthier.
Right.
The risk is weak data could really ramp up slowdown fears. But strong data might suggest consumers are, surprisingly, still absorbing price pressures. Keep an eye on Friday the 15th for retail sales and Michigan sentiment.
Got it. Risk 3.
Third, UK growth shock. Important because the BOE just cut rates on that split decision. This GDP data will show if it was justified. The risk. A sharper slowdown could actually argue for more easing.
Signaling deeper problems.
Right. Or stronger growth could make the B's move look premature, complicate their path. Watch those GDP figures on Thursday the 14th.
Okay, fourth risk.
Germany's business confidence. That ZEW index on Tuesday. It'll gauge if industry leaders see any recovery coming after that rough patch for industrial output. The risk is obvious. Weak optimism reinforces those Eurozone slowdown concerns, especially given Germany's role, could ripple across Europe.
Makes sense. And the fifth risk.
Finally, number 5, China's domestic demand pulse. This data is vital. It shows if the recovery is really broadening beyond exports into genuine domestic strength, or if it's still mostly external trade.
And the risk.
Weak industrial production and retail sales would signal maybe a fragile, externally driven rebound, not the robust internal recovery policymakers want. Watch for those releases on Friday the 15th.
Okay, so bringing it all together for you listening, the past week showed us tech strength and central bank flexibility are keeping markets surprisingly buoyant, even with those intensifying tariff pressures.
Yeah, it's a balancing act.
And this coming week's inflation and growth data, absolutely critical for shaping what happens in September policy-wise across all the major economies.
Definitely. And I think the market's main focus is now shifting quite sharply from just pure rate speculation to a much more intense watch on actual economic growth.
Good point.
So if next week's inflation or GDP prints surprise, either way, up or down,
Okay.
expect volatility to spike and spike fast as traders recalibrate.
Right.
So as you process all this, maybe think about what specific data points you will be watching most closely. What clues are you looking for about where the smart money might be heading next?
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.